You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Burberry, AutoTrader, Ted Baker, M&S, B&M, and our US company of the week is Disney. So Sam, let's start with Burberry.
Yes, so Burberry have come out with their half-year results and they have announced half-year revenues of 1.2 billion, which represents 45% year-on-year growth once currency movements are accounted for and are broadly in line with what was achieved pre-pandemic. That reflects strong growth in the Americas, China and South Korea, with strong growth in leather and outwear. Underlying operating profits rose fourfold to 196 million. That reflects higher gross margins as the group focused on reducing discounting and product elevation, driving higher prices. The group announced a dividend of 11.6p a share compared to no dividend a year ago. And the group also announced a £150 million share buyback. And the shares fell 7% on the announcement. So if we go in a bit more detail, on the retail side, sales rose 41% year on year to 944 million, with like-for-like sales up 37% and 4% growth from new space. Regionally, the Americas were the standout, with sales up 92% year over year and 38% ahead of pre-pandemic levels. EMEIA, which is Europe, Middle East and Africa, saw sales rise 58%, but remained 31% behind pre-pandemic levels, while Asia-Pacific sales grew 9% in the half and are 5% ahead of pre-pandemic levels. Wholesale revenues rose 69% to 249 million, with strong demand across all regions, with licensing up 13% to 20 million. Operating costs rose 22% to 645 million, despite 20 million pounds of cost savings, as the group increased investments and costs normalised. Free cash flow in the half was 104 million, up from a 45 million pound outflow last year. Net debt, including lease liabilities, was 224 million, up from 101 million at the start of the financial year, and well below the group's target of 0.5 to 1 times cash profits. It's worth noting that although Europe was down and a lot of the Asian customers haven't quite come back as they were, obviously the Americas is doing very well. And it's now, like I said before, it's now at pre-pandemic levels. And that's partly to do with the previous CEO, Marco Gabetti's strategy, which was to position them much higher end and stop the discounting and stuff like that. And that strategy was working. However, Mr. Gabetti resigned at the end of June. So it remains to be seen whether the new CEO will actually be able to carry this on. In terms of the valuation, the company's trading at a P ratio of 21.3, and that compares to a 10-year average of 20.4, with a prospective dividend yield over the next 12 months of 2.6%. My view is, I think these are pretty decent results. I actually think the fact that the Americas is very positive, and that's the fact that they are basically at pre-pandemic levels now. I'm going to be honest, they're at pre-pandemic levels a lot sooner than I thought they were. I think I was pretty critical of them last time we covered them because I thought it could be a while before they got back to it, but I didn't expect the Americas to do as well as it did. But in terms of, they are at pre-pandemic levels, but that's without Europe performing. So they could still go a bit further, I think. I think at P of 21 and a dividend yield of 2.6, I think it looks pretty reasonable. What about you, John?
Yeah, no, I would tend to agree with you. And it's a strong brand as well. So I don't think it's, with the figures that have come through, it's actually, I wouldn't say too expensive now. But yeah, like you, I would have thought that it would have taken a lot longer to get back to this point.
I suppose if the Americas up 38% ahead of pre-pandemic, that's why they've gotten away with it. Because otherwise,
yeah,
if the Americas had just returned to pre-pandemic levels, it would have been still be down, but there's obviously a bit of growth in it.
Do you think you'd be buying shares, or would it even go onto the watch list?
I think it probably is good enough for the watch list. I do think it's a good brand. I think it looks like a good business. I think it probably is good enough for the watch list, actually. In terms of the share price, not really done very much for a long time, actually. So they're currently at £19.50 a share, and that compares to a 52-week low of £16 and 52-week high of £22. And over 5 years, they're up 34%, 3 years, they're up 11%, and 1 year, they're up 20%.
And has there been any news from the new chief executive in terms of strategy going forward?
My understanding is it's just going to carry on with the previous strategy.
Okay.
I'm not aware of any massive changes. That's not ideal, actually. I would say that, because it looked like the previous CEO was doing a pretty good job based on how the company's now doing. But
no, it was Versace's CEO is the new Burberry CEO, but where
it says he wanted to go back to Italy. So he was just.
Oh right. So
I don't know if he's actually gone somewhere. Or if he was just maybe he was just homesick.
It's homesick. Okay, fine.
Right. Shall we move on to AutoTrader?
Right. Yes. So AutoTrader, I'm sure it's a brand you're probably familiar with, but primarily involved in the second-hand car market through its website and its app. They had their half-year results out this week, with the group achieving its highest ever half-year revenue and profit. Revenue was up 82% to £215.4 million, which is 15% up on pre-pandemic levels. And in a similar way to Rightmove, AutoTrader had reduced its advertising fees for customers during the pandemic, but now they're back up, and average revenue per retailer came in at £2,199, which is up from the £993 last year and the £1,206 pre-pandemic. Price rises accounted for £74 of the increase, while the adoption of more expensive advertising package made up £119. Average monthly cross-platform visits were up 20% in the half to just under 69 million, and people are spending longer on the site as well. The average number of retail forecourts advertising on AutoTrader were up 6% to 13,892. And the retailer and trade divisions both saw revenues rise over 90%, with the retailer up to £183 million, which is a 94% increase, and trade up to £192 million, which is a 92% increase. The resumption of normal marketing spend, that meant costs rose 29% to £65.4 million, and AutoTrader generated free cash flow of nearly £140 million and had net cash of £9.2 million. Operating profit more than doubled to £151.7 million, with margins rising from 58% to 70%. And the group declared an interim dividend of 2.6p. The group also commented, for the full year, we now expect modest year-on-year growth in retailer forecourt numbers and low double-digit ARPR growth of 2020 levels. The stock lever, which shows the year-on-year movement, is likely to represent a small headwind for the full year, as we lap a strong second half last year. In terms of valuation, AutoTrader has a market cap of just over £6.8 billion and trades at nearly 25 times earnings, which is more or less in line with its 10-year or its average since listing. And it currently yields about 1.5%. So, I mean, I was really impressed with these results. AutoTrader is a company that since starting the show, I'm growing to like more and more. It's, I suppose, very similar. It's almost the Rightmove equivalent, but in the car market. I've used the app many times when I've purchased my own cars, and I've sold through it too. It is, I suppose, the Rightmove of the second-hand car market, or you might argue even some new cars that are being sold. It's very intuitive and it's got those huge margins. So it's attractive. I don't think it's probably overvalued. I would wonder how much more revenue you could get, but with margins like that, it's a business that I'd probably consider investing in.
I agree. I actually used to have it. I only had it briefly. I only had it for a few months, and then I sold it because I wanted more Rightmove.
Oh.
Well, yeah,
okay.
That's life.
Yeah.
But for me, it was just Rightmove. They are very, very similar. Like, if I'm comparing AutoTrader to something, I wouldn't compare it to like one of the other car. So I would compare it to Rightmove. That's probably the most similar business to me. But Rightmove for me was the better business. But these are very good results. It's a very good business. And I think the margin improved, the operating margin's going up to 70%. They are actually now pushing Rightmove levels of margin. And I don't see, when you look at Rightmove and the margins they have, why they can't go up a little bit more as well. I think these are really, really good results. I guess the only caveat would be, would you expect really good results given what's going on in the second-hand car market right now?
Yeah, so I suppose that's driving the chip shortage, causing the delays in the new cars and production there. So I suppose that is underlying this too. So yeah,
I would say with a business with as much pricing power as AutoTrader has, I think a P of 24 is pretty reasonable.
Yeah, no, I would agree. And do you use it personally?
I used it when I bought my own car 5 years ago.
Yeah.
Touch wood, I haven't needed to use it since, but I'm sure next time I do need
But
to buy a car,
yeah.
it will be AutoTrader.
And selling your current car if you do?
I'm planning to drive it into the ground, I think.
Yeah.
I don't think it'll have much resale value when I'm finished with it.
You'd rather spend the money on AutoTrader stock than
or Rightmove stock in my case.
Or Rightmove stock. Okay, fine. Okay. Well, what about Ted Baker stock? That's the next company we've got.
Well, we were pretty critical of it last time we covered it. Spoiler alert, I'm going to be pretty critical again of it. Okay. So Ted Baker have come out with their half-year results, and relaxed COVID restrictions helped half-year revenue rise 21.4%, excluding currency changes, to 199.3 million. However, revenue is still 36.4% below pre-pandemic levels. The proportion of items sold at full price rose by more than 5 percentage points, which helped pre-tax losses narrow to 25.3 million from 86.4 million. In the 12 weeks to 6 November, revenue rose 20%, and the recovery in retail sales has been uneven, with stores exposed to travel retail continuing to struggle. Full price sales continue to grow as a proportion of sales, though less proportional activity meant e-commerce sales fell 10%. Management now expects to have a net cash position by the year end and is comfortable with market expectations for full year revenue of 468 million and a 23.8 million pre-tax loss. The new e-commerce platform is on track to launch in early 2022. So if we break them down a bit further, retail revenues rose 14.1% to 136.9 million. And city centre and airport locations that rely on tourists and office workers have had weaker recovery compared to out of town and shopping centre locations. E-commerce revenue declined 12.2% due to less promotional activity, but rose 21.6% on a 2-year basis. Underlying gross margins rose 4.8 percentage points, and underlying operating costs fell to 82.4 million from 83.2 million. Retail sales in the UK were up 1%, with e-commerce sales making up just over 56% of sales. North American retail sales rose 46.1% as the group continues with its restructuring efforts. E-commerce sales there declined 16.9%, but remain 51% above pre-pandemic levels. Supply chain disruption and an increase in discounted products sold in North America weighed on the wholesale division. Despite this, sales rose 45.2% to 55.5 million, and underlying gross margins increased to 31.1% from 29%. License income rose 15.1% to 6.9 million, reflecting strong growth in eyewear and an evolving partnership in children's wear and lingerie. Formal wear continued to show weakness due to fewer events and working from home. The group had free cash flow of 22.8 million versus a 24.5 million outflow last year, excluding the proceeds of the sale of the group's London head office. The group had a net cash position of 12.7 million compared to 60.7 million in mid-August. In terms of the valuation, there's no earnings, there's no dividend. On a price to sales ratio, it trades at 0.72 compared to a 10-year average of 1.83. My view of these results, I do have a positive thing to say this time, which I don't think I did last time. But I think the full price sales increasing as a proportion of sales is good, because I think they are associated with almost like being I think they've discounted the value of the brand a bit too much. So it is good to see that moving in the right direction. But I think in this environment, to have e-commerce sales down 10% and only, only 21% above pre-pandemic levels, I think is just absolutely unforgivable. I think it's just shockingly bad. I would not touch it on that basis. What about you, John?
Yeah, no, I would agree with you there. And I mean, the revenues for 2021 are still down about 50% if you compare it with 2019. So it's got, a huge way to go. And if you're, like you say, if online sales are down as a percentage, it's not a good sign. And I think the share price reflects that. In the last 5 years, it's down 95%. I wouldn't be buying Ted Baker shares. I would wonder whether one of the, your ASOS or your Boohoo would eventually pick it up if it does continue to decline. And
I think the brand is
eventually goes under.
But I'm not sure about the business.
No. So no, I'd be the same. I wouldn't be buying shares.
Yeah, it's just not. It's not the kind of. It is a falling knife, really. I think there might be some value there, but it's just. I just don't know why you'd want to take the chance.
Yeah.
But
well, especially not when you've got your auto traders around. I'd rather pay up for that.
Yeah.
Or Burberry. Again, much rather pay. What was it 19 times? Was it 23?
20,
23
something
times
like that. But yeah. Call me old fashioned. I just like companies that have actual just earnings. It's nice.
Well, yeah.
Unless they're American, then we let them off.
Yeah. Well, the next business is another retailer, M&S. Once a stalwart of the British High Street food and clothes retailer, they had their half-year results out with revenues up 5% on pre-pandemic levels to £5.1 billion, with solid growth in food and a recovery in the clothing and home as well. In terms of the clothing and the home business, which had traditionally, or in the last few years anyway, been the weaker part of the business, it increased overall market share, both in store and online. Sales actually fell 1% to £1.5 billion, but online sales grew 60%, which now accounts for over a third of total sales. And underlying operating profit was up 42.5% to £156.2 million. The group also managed to sell more of its excess stock from lockdowns, which released a further £15 million previously put aside as provision. And a £58.1 million charge was incurred in relation to store closures, with further charges expected to be around £227 million, with a strategy to shrink the estate. In the food division, which has an ongoing partnership with Ocado, sales rose 10.4% to £3.1 billion, with underlying operating profit up nearly 56% to £143.7 million. Discounting had been reduced, and frozen food, grocery, household and alcohol all did particularly well, and basket size rose 30% compared with pre-pandemic levels. Free cash flow came in at £287.6 million, which was actually down 1.6%, and net debt fell from £1.4 billion to £1.1 billion. Underlying profit before tax came in at £269.4 million, which is nearly 53% higher than pre-pandemic levels. And the shares were up nearly 15% on the news. In terms of valuation, M&S has a market cap of £4.6 billion and trades at just under 12 times earnings, which is approximately in line with its 10-year average. And it yields around 2.5%. And interestingly, it's only trading at about 8% above the 2019 levels, despite those, I wouldn't say record profits, but despite the increase in those profits. In terms of M&S as a company, it looks like the turnaround now is really beginning to take shape. And we have been critical of it over the last year, but now I think it is actually starting to deliver on the strategy. I don't have a particularly strong affinity with the brand, but I know a lot of people do, and still got an expensive estate, but they do have the plans going forward for that and making it more streamlined. So I think it definitely looks like a more attractive business than it has been at any point in the last 5 years, and it's still a very reasonable valuation. Probably not for me, but I could see why you might buy shares at the moment. What are your thoughts, Sam?
I like it. I mean, these are very, very good results. I think it is a turnaround, and it is turning around. I think management are doing a very good job with it. I think we've covered it on the show before. I think we were quite critical of it. I think it's looking pretty good now. I think the valuation's pretty reasonable. I think, like you say, it's only just above the 10-year average, and it's probably in the best shape it's been in for 10 years.
Yeah.
The prospective dividend yield, 2.5%, is pretty reasonable. I think it looks quite decent, actually. The best comparison for it is probably the supermarkets. I probably prefer it to Sainsbury's, which we looked at a few weeks ago now. And I don't know if that would have been the case last time we covered it on the show. And the online sales for the clothing and home growth of 60%, and what did it say? It's now making up a third of total sales. I think that's quite impressive as well. No, I think that they're doing a good job.
Would you add it to your watch list? Would you buy shares?
I don't know if I'd add it to the watch list. It's not the sort of company I would go for, but I think I understand why someone else might. Whereas
What do you think of
before
the
I would have said,
yeah.
what are you doing with that?
Yeah. And what do you think of the clothes and the home business now? Because that had been the laggard with the business before.
But it seems to be moving in the right direction. And I mean, it's not like if the online sales can start making up more and more, a higher proportion, it could start contributing quite nicely to profits. It's not like the groceries where they're not really making much money on the online sales. If they get decent online sales, I know they're not going to continue growing at 60% a year, but if they can carry on growing the online sales nicely, that could be a lot more profitable than it was when it was all in store.
Yeah, that's right. And slimlining the estate as well.
Yeah. No, I think it's starting to look like a decent business.
Okay, so on to another retailer, B&M.
Yes. So B&M have come out with their half-year results, and total group revenues increased 1.2% to 2.268 billion. And for the breakdown of that, 1.9 billion was from B&M UK, 200 million was from Heron Foods, 155 million was from the France side of the business. In terms of the number of stores, that increased overall by 3.6%, and that was made up of a 4.4% increase of B&M UK stores to 686, 2.7% increase of Heron Food stores to 307, and a 1% increase in the France stores to 104. In terms of the adjusted EBITDA, that was down 4.6% to 282 million, and that was made up of a 6.3% drop for B&M to 257.4 million, a 26.7% drop for Heron Foods to 13.4 million, and a 324% increase in France to 11.4 million. And the group's adjusted EBITDA margin fell from 13.2% to 12.4%. The group's adjusted profit before tax fell 6.2% to 238 million. Statutory diluted earnings per share was up 1.7% to 19p, but the adjusted diluted earnings per share were down 7.2% to 18.7p. So because they've adjusted it downwards, we'll assume the adjustments are fairly reasonable. Simon Aurora, CEO, said, "Group has performed strongly throughout the first half of our financial year, customers continuing to be drawn to our value for money offer. We've responded decisively to supply chain challenges by leveraging our strong supplier relationships, and we've improved in-store execution. As a consequence, we're fully stocked heading into the golden quarter, with stores already showcasing our excellent Christmas ranges. To colleagues across the group, I express my gratitude for their dedication, skill, and commitment, which have made these results possible." The revenue increase is quite good. Obviously, that's not fed through into the earnings, but I think when you look at the comparatives they're up against, I think these are actually quite decent results just to hold their own in terms of, because their COVID figures were very, very good. Some of that was because they managed to get themselves classed as an essential retailer, so they stayed open. We won't comment on how essential they actually were, but they were up against very tough comparatives. So there were quite a few interesting points in the slides, actually. So the first one was that they've rebranded 45 stores in France. So 100 of the 104 France stores now operate under the B&M banner. And the adjusted EBITDA is actually, although it's down year over year, it's actually up if you take out the business rates relief that was received last year. So it's not quite as bad as it looks on the surface. They did a little slide about navigating macro headwinds. So there were a few interesting points in that. In supply chain disruption, they talked about their direct sourcing model and strong supplier relationships, making them more agile and responsive than competitors. They said they've got a long-standing shipping partner for goods sourced out of Asia, with service levels not materially compromised in 2021. For the 2022 calendar year, freight rates have been negotiated and they expect a manageable level of inflation. And they said they're monitoring power restrictions in China closely. Their simple buy-in model and payment terms will help deliver continuity of supply. In the inflation pass-through section, they've said that they're well placed to maintain their disruptive price positioning. So far, they're not seeing any signs of competitors having the appetite or ability to absorb inflationary price increases. And they've said on the non-grocery ranges, they operate on a level playing field, but have the advantage of scale derived from their narrow but deep buying model. They mentioned that labour inflation has been limited to areas such as warehouse operatives and heavy goods vehicle drivers. And in the normalisation of trading conditions section, they've said price becomes even more front of mind for consumers in an inflationary or recessionary environment, and they're able to respond quickly to price pressures. And the example they gave was that a 5-pack may become a 4-pack at a certain price point. They said that B&M stores are increasingly seen as a destination visit, and 201 of them now have a garden centre. They have 686 B&M stores as at September 2021, but they're targeting 950. So almost 50% store growth. that they're targeting. They've said that new stores do not typically need a maturity curve and are immediately profitable. And they had a little slide on their Instagram followers. So if we go through all the supermarkets, Lidl have 296,000 followers. Aldi have 691,000. Morrison's have 274. Sainsbury's 312. Asda 538. Tesco 474. B&M are by far and away the biggest with 1.381 million Instagram followers, and that's up 22% in the last 12 months. They've given outlook for the second half of the year, and they've said in the first 6 weeks of Q3, like-for-like sales have been 14.7% higher on a 2-year basis, and that represents an 8.9% decline versus the first half of the 2021 financial year. However, that's quite heavily skewed by unusually early Christmas trading last year, which saw a very busy November and quieter December. So I think they're expecting that to reverse. In terms of the valuation, the business is trading at a P of 14 and has a dividend yield of 2.96%. My view is I think these are decent results given the comparatives they're up against. I think it's a quality business. And I think if they can get to 950 stores, I think a P of 14 is pretty reasonable. What are your thoughts, John?
Yeah, I mean, I think the chief executive summed it up well when he said there are not many businesses that can grow their earnings by 86% in the past 2 years. And yes, the revenues didn't feed through to earnings as you might have liked, but at 14 times earnings, and I think it's got quite a strong brand in itself. And like you said, a social media following. I think it's still pretty decent value actually, and a business that I would consider owning. So it would be one for my watch list.
Yeah,
I think
I like it.
It was similar last time, although yeah, on the back of slightly better results.
Yeah, no, I also like it. I think it's a very well run business.
Yeah, no, absolutely. And yeah, one that I'd choose over M&S and definitely Ted Baker.
Should we move on to another very well run business?
Oh, okay. So Disney, yeah, a company again that doesn't really need any introduction, but they had their fourth quarter results out with revenues rising 26% to $18.5 billion, with growth across all divisions and park revenue particularly improving, and the quarterly operating profit more than doubled to $1.6 billion. And in fact, Disney Parks, Experiences and Products saw revenue for the quarter come in at $5.4 billion, which was up from the $2.7 billion a year earlier. The Media and Entertainment Distribution division saw revenue rise 9% to just over $13 billion. Within this, the direct-to-consumer was up 38% to $4.5 billion for the quarter and up 55% for the year. Disney Plus currently has just over 118 million subscribers, and that's up from 73 million at the same time last year. Linear networks actually saw revenue fall 4% to $6.6 billion, but full year sales were overall up 3% to $67.4 billion, with free cash flow of $1.9 billion, which is a 45% rise. And Disney said that this has been a very productive year for the Walt Disney Company, as we've made great strides in reopening our business while taking meaningful and innovative steps to direct consumer and at our parks, particularly our popular new Disney Genie and Magic Key offerings, said Bob Chapek. As we've celebrated the 2-year anniversary of Disney Plus, we're extremely pleased with the success of our streaming business, with 179 million total subscriptions across the direct-to-consumer portfolio at the end of the fiscal year 2021, and 60% subscriber growth year over year for Disney Plus. We continue to manage our direct-to-consumer business for the long term and are confident that our high-quality entertainment and expansion into additional markets worldwide will enable us to grow further our streaming platforms globally. In terms of valuation, Disney currently has a market cap of around $287 billion and trades at just under 35 times earnings, with a 10-year average of just under 22 times earnings, although the 2021 earnings are depressed for COVID-related reasons, and the parks business not being back to how it had been pre-pandemic. I mean, we've talked a lot about Disney in the past on the show. I suppose these results, the market was slightly disappointed by them, and they priced in higher revenue and higher growth. But ultimately, I think they're still good numbers, and I'd still be buying Disney even on the back of those. And I don't think it's an outrageous valuation to pay for such a high quality business. What are your thoughts on these latest results and the market reaction?
I agree. I think they're good results. I think the main reason the stock was obviously the revenue didn't grow as much as they wanted. I think we're both Disney shareholders, aren't we?
Yeah.
I do not care about the revenue growth at this point because eventually it will get back to pre-pandemic levels and it's going to have Disney Plus on top of it. I think another reason why it was the market was disappointed with the Disney Plus subscribers only grew quarter over quarter about 2 million. But I just think even Netflix has had quarters like this where it's had a little wobble. It's 2 years old and it's got 118 million subscribers. That is ridiculous. I think if it's going to have some slow quarters now, you've just got to accept that some of the subscribers have been pulled forward because of the pandemic, and that's not a bad thing. Yeah, so I think at a P of 34 when it's on depressed earnings and it's got Disney Plus, which I think will seriously contribute to the earnings in say 5 years' time, I think it's very, very reasonably priced. And I would not be against adding to it at these levels. I think anyone who's unhappy with these results is just, well, I think they've been a bit short-sighted, to be honest.
So of the companies then this week, what would you be buying? Or should we separate it? Should we say
we're going to exclude Disney? Are we?
Yeah, I think we should.
I agree. I'd be picking Disney, excluding Disney. AutoTrader.
Yeah, it's quite boring because I'd also go for AutoTrader.
I bet you'd have Ted Baker last as well, wouldn't you?
I probably would, but then I suppose second, what would you have?
Well, after Disney and AutoTrader.
Yeah.
I'd have B&M.
Oh, okay.
Would you have Burberry after that?
No, I probably would have B&M, and then, but yeah, I think. Okay.
No, but would you do Disney, AutoTrader, B&M, Burberry, M&S, Ted Baker?
Oh, I probably would. Yeah, I probably would.
We've got the exact same order for the six.
It'd be a little bit of a toss-up between Burberry. Well, no, I do prefer Burberry to M&S. So yeah, no, that's how it would be.
We've got the exact same
I was just trying
order.
To see a bit of that. Yeah, trying to be a bit different, but no, that was unfortunately this week it's a little bit boring. But
it's always a boring week when we do Disney though, because we always both pick it.
Well, actually, but the rest of the companies as well has been a little bit because we've agreed on them. But we'll see what comes up next week. So there are some interesting companies that do divide opinion. So join us again then.
Right, see you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.